So, what if one of the most successful investors on the planet told you that you've been looking at the markets completely wrong? I mean, we spend so much time sweating over which exact stock to buy or staring blankly at daily charts that we kind of miss the forest for the trees. But what if the absolute biggest investment mistake you can make isn't picking the wrong company, but just fundamentally failing to understand how the broader economy actually works? Welcome to This Explainer. Today, we're unpacking the timeless investing principles of a literal legend in finance, Ray Dalio. We're going to look under the hood of his overarching strategy, take his complex macro framework, and distill it into actual actionable principles. We'll also break down exactly how he built Bridgewater Associates into an absolute titan of a hedge fund. By the end of this, you'll see the core wealth building strategies that drive his multi-billion-dollar decisions. And more importantly, what we can all learn from his incredibly structured approach. Okay, let's dive right into the roadmap for today. First up, the Ray Dalio story. Then we'll get into the economic machine explained. Third, the power of diversification, which naturally leads us into number 4, the all-weather portfolio. And we'll wrap it all up with principles over predictions. All right, starting with section 1, the Ray Dalio story, from his early investments to becoming a hedge fund titan. So, how exactly does a guy go from making modest childhood investments to just towering over the global financial landscape? Well, as you might guess, it's definitely not a straight line. By year 10, Dalio had founded Bridgewater, but man, year 15, that brought some massive, very public failures. Picture this. In 1982, he boldly predicted a global depression on national television, was dead wrong, and lost so much money, he literally had to borrow $4,000 from his dad just to pay his family's bills. Crazy, right? But that exact crucible shaped his entire philosophy. He realized his ego had to go, replaced by a rigid system to ruthlessly learn from his mistakes. Moving on to section 2, the economic machine explained. Let's look at the gears of the economy. Now, what's really interesting about this is how Dalio takes a super intimidating subject, global macroeconomics, and just simplifies it into a mechanical, predictable engine. At its core, the economy is basically just a massive collection of repeated transactions driven by 3 main gears: productivity growth, short-term debt, and long-term debt. When you pull the lever on credit, you're essentially borrowing from your future self, right? It lets you consume more than you produce today. But eventually, that debt comes due, meaning you're going to have to consume less later on. This constant push and pull, that's exactly what creates the booms and busts we're always seeing in the markets. And those credit and debt levers create 2 massive overlapping cycles. You've got the short-term debt cycle, which usually lasts a few years and is driven by central banks tweaking interest rates to control our spending. But then, if you zoom out, there's this much larger long-term debt cycle. That one takes decades to play out. It slowly builds systemic debt until, eventually, a major restructuring has to happen. Now, this framework is an absolutely brilliant tool for understanding exactly where we are in the economic cycle, but keep in mind, Dalio uses it strictly for preparation, not prediction. Which brings us to section 3, the power of diversification and managing risk across asset classes. So what does this giant macroeconomic machine actually mean for your personal portfolio? How do you protect yourself when those heavy gears inevitably shift? Well, diversification is for sure your best shield. But let's be super clear here. It cannot completely eliminate losses. It's not a magic force field. But proper asset allocation is your strongest defense against the unknown. It ensures that if a catastrophic event hits one sector, it doesn't just completely wipe out your entire financial future. Remember, the goal here is resilience, not absolute invulnerability. Think of different asset classes as crucial shock absorbers, depending on the specific economic weather we're facing. Stocks, they tend to thrive during periods of high growth and low inflation. Bonds, on the other hand, typically perform inversely. They're the net that catches you when economic growth slows down and interest rates drop. Meanwhile, assets like commodities and gold, they protect your purchasing power against currency devaluation when inflation starts running hot. By holding a non-correlated mix of these assets, the exact same economic event that crushes one piece of your portfolio will actually end up benefiting another part of it. All right, section 4, the all-weather portfolio. Let's talk about investing across different economic environments. And this right here brilliantly illustrates where Dalio's macro theories get put into practice. The logic behind the famous all-weather portfolio is simple. Since there's no way we can perfectly predict whether the future will bring higher growth, lower growth, inflation, or deflation, we have to build a portfolio designed to survive all 4 of those distinct economic seasons. But here's the kicker. Instead of just balancing dollar amounts across assets, this allocation balances risk. It's a conceptual approach aimed at capturing steady growth, but with significantly less stomach-churning volatility. Now, while this exact mix isn't a universal recommendation for every single investor, the underlying philosophy of preparing for all seasons, it's a total game changer. Let's head into our final part, Section 5, Principles over Predictions. We're looking at the mindset of a successful investor. Because building the right portfolio is honestly only half the battle, right? The other half is having the actual discipline to stick to it. Dalio leans heavily into data-driven decisions. He looks at the cold, hard facts of the economic machine rather than just trusting his gut. He also champions independent thinking because, let's face it, following the herd basically guarantees you average results. Crucially, he relies on emotional discipline to stay anchored to his strategy, especially when human instinct is screaming at you to panic. And finally, continuous learning. Replacing your ego with established, tested principles is just vastly superior to desperately trying to predict the future. So, we've covered the mechanics of his investing strategy today, but the actual engine that powers his entire firm is something completely different. Coming up in part 2 of this explainer, we're going to pull back the curtain on Bridgewater's legendary internal culture. We'll explore the wild concept of radical transparency, look at some of the most common investing mistakes that trip people up, and distill the practical, long-term habits you can actually start using today. So, I want to leave you with this question to chew on. Are you ready to embrace radical transparency to build your long-term wealth? Are you really willing to look at your own financial mistakes with brutal honesty so you can actually grow? I hope this explainer has completely shifted how you view the economic machine. Keep learning, keep diversifying, and I'll see you in part 2. Welcome to this explainer. Today, we're going to decode the blueprint behind Ray Dalio's legendary success and figure out exactly how his unique approach to systems thinking can totally transform your own decision-making. Look, whether you're already deeply embedded in the financial world or just someone looking to, optimize how you navigate everyday challenges, Dalio's framework offers an absolutely fascinating lens through which to view the world. Let's get right into it. Here's our roadmap for today. We'll start with the Dalio philosophy, take a look inside Bridgewater Associates, cover some common investing traps, lay out a beginner's playbook, dive into principles for everyday life, and finally, discuss the future of investing. So, Part 1, the Dalio philosophy. To set the stage here, we really have to recap his fundamental belief in macroeconomic principles. Dalio didn't just look at individual stocks, right? He looked at the overarching economic machine, how debt cycles, interest rates, and human nature all interact on a massive global scale. From his early journey, he figured out that the absolute necessity of diversification is basically the only true free lunch in investing. When you take that deep understanding of global economics and combine it with a strict, unwavering commitment to long-term investing, you really start to see the architecture of a highly resilient portfolio. It's literally about removing the guesswork and replacing it with a structured understanding of how the world actually works. Which brings us to part 2, inside Bridgewater Associates. Now, one of the most fascinating pillars of Bridgewater is this concept of radical transparency. Just imagine working in an environment where brutal honesty isn't just encouraged, it's systematically required. The whole goal here is to completely eliminate human ego from the equation. When open data and direct, unfiltered feedback drive every single decision you make, you completely strip away the messy office politics that drag other organizations down. They literally record meetings, they track performance meticulously, and they rely purely on the data to reveal the truth, rather than falling back on traditional, comfortable corporate hierarchies. It's intense for sure, but it works. And that level of transparency feeds directly into what he calls a meritocracy of ideas. Think about a standard company. The CEO's idea usually wins because, well, they're the CEO, right? Under Dalio's system, that doesn't matter at all. The best, most data-backed idea always wins out, regardless of a person's rank, tenure, or title. If a first-year analyst has the hard data to prove a senior partner's thesis is flawed, guess what? The analyst's idea wins. It just goes to show that when a company culture values truth over comfort, the absolute most optimal decisions inevitably rise to the top. It's a super clinical yet highly effective way to process information. Okay, part 3. Common investing traps. Let's be real, human psychology actively works against us. We're so deeply tempted into emotional investing. We see a stock rocketing up to the moon, we get hit hard by FOMO, and we just blindly chase trends. It's completely natural, but it's the exact opposite of Dalio's approach. And honestly, this is exactly why having a rigid, research-backed, disciplined process is so incredibly necessary. It literally acts as your shield against your own emotional impulses. Along those same lines, we also tend to succumb to our own overconfidence and short-term thinking. You know the feeling. We get a few lucky wins, and suddenly we think we're absolute geniuses, disastrously ignoring the underlying risk. The antidote to that kind of overconfidence: long-term consistency and diversification. Because if you lack diversification, a single unexpected event can entirely wipe you out. But by structuring a portfolio to survive literally all economic seasons, which is kind of what Dalio is famous for, you completely remove the danger of your own overconfidence. Moving on to part 4, a beginner's playbook. Now, while we definitely aren't giving personalized investment advice here, any beginner can, and really should, adopt this universal sequence. Step 1, relentlessly build your financial knowledge. You simply can't build a machine if you don't understand the parts. Step 2, set rigid, long-term goals. Your timeline shouldn't get measured in weeks or months, but in decades. And step 3, practice extreme consistency and patience. Because the most beautifully designed system in the world is completely useless if you abandon ship the moment the market gets a little turbulent. Furthermore, risk awareness absolutely must be baked directly into your system. You have to always understand the potential downside before you even consider chasing the upside. Amateur investors are always asking, how much money can I make? But systemic, disciplined investors, they ask, how much money can I lose? And can I actually survive that loss? Forcing yourself to logically evaluate the downside is what keeps you in the game long-term, rather than emotionally hoping for some massive one-time payout. But that poses a really deeply fascinating question, and one that takes us right to the heart of Dalio's broader mindset. What if this isn't just about money? How can we actually take this exact same systemic logic, the same risk awareness and discipline, and use it completely outside the realm of finance? Let's explore that in part 5, Principles for Everyday Life. So Dalio's ultimate thesis is that absolutely everything in existence is a machine. And yes, that includes your personal life, your relationships, and your career progression. By embracing systems thinking, you stop viewing your failures as these huge personal tragedies and you start viewing them simply as data points. You can aggressively learn from your mistakes. You can actively seek out honest, unfiltered feedback from your peers to eliminate your own blind spots, exactly like they do at Bridgewater. When you start treating your life like a machine that can be tweaked and optimized, you essentially ensure that you're always focused on continuous adaptability and improvement. Finally, let's wrap up with part 6, the future of investing. Rather than trying to make wild, speculative predictions about tomorrow's stock prices, a systems thinker actually looks at the major structural forces at play. We really have to recognize that massive technological innovation, the rapid rise of artificial intelligence, and constantly shifting global markets are basically going to guarantee one thing: continuous economic uncertainty. The variables are just changing faster than ever before. And because of that, in this rapidly changing landscape, your best defense isn't a crystal ball. Your best defense is a commitment to staying continuously informed. Thorough research and just unwavering adaptability are what will actually protect you. When you have a solid process for ingesting new information and updating your models without all that emotional bias, you can pretty much navigate any economic environment thrown your way. Honestly, Dalio's ultimate lesson perfectly distills our entire explainer today. Legendary success does not come from finding a single perfect investment. It comes from developing a replicable, disciplined process for learning, for managing risk, and for making thoughtful, data-driven decisions over a very long horizon. So, as we conclude our time together today, I want to leave you with this one thought to ponder. The principles are laid out right in front of you. The blueprint is there. So how are you going to build your own machine to mitigate risk, learn from your inevitable failures, and make better decisions in both your life and your finances? Keep learning, always think long-term, and I will see you in the next explainer.